Friends, I have already covered agenda for options, strategy, training for learning purpose. I have told you the topic, what I am going to cover. Basic of options already covered, then implied volatility, then payoff for the options. So now let's start with the strategy. First strategy options is covered call strategy. Time frame can be used 15 minutes. Preferably this can be used in swing trading. Trade setup, stock market, bear or bull. Trade with primary trend and select stock as stock selection criteria. To trade in options, you must aware of technical analysis, use of indicators, use of support resistance that will be applicable. Without knowing, you will not able to do options trading. Trading paper time is 9:20 am to 11:30 am as per Indian timing. Trade in with highly liquid stock, preferably Nifty 50 or large cap stocks, because they move with Nifty. If Nifty go down, then they go down. If Nifty comes up, they comes up, and they have a good ATR range, average 2 range. So their band is big, so you can enter and get in the profit. All strategies in stock market should be avoided in range bound or sideways market. We must not trade it in during the period. The period recommended for range bound or sideways market is 11:30 am to 1:40 pm as per Indian timing. So let's go ahead. Covered call strategy. What is covered call strategy? So covered call refers to the transaction of financial market in which the investor selling call option owns the equivalent amount of underlying security. To execute this, investor holding a long position in asset then write or sell a call option on the same asset to generate income stream. The investor long position in the asset is the cover because it means seller can deliver shares if buyer of the call option choose to exercise. If investor simultaneously buy stock and write the call option against the stock position, equal position, then it is known as a buy write transaction. So this is the definition of covered call strategy. You have to take delivery on stock and same amount of stock you have to sell it. What is the outcome of covered call strategy? Let's go ahead. A covered call is a popular option strategy used to generate income in forms of option premiums. To execute cover call, investor holding a long position in the asset then write sells call option on the same asset. So you have to use the same asset, same stock. It is often implied those who intend to hold underlying stock for a long time but do not expect an appreciable price increase in near term. So let's say if you taken any stock which is not highly liquid, but you see in long term that is going to give you profit. Maybe reason might be anything, might be you might expecting good dividend, high dividend, or you might expecting a good profit or ROE. So you can trade in that those stock, but near term you see their price will not move. This strategy is ideal for the investor who believe the underlying price will not move near term. So this you must take into consideration. Understanding of covered call strategy. So let's understand what are the basic points in covered call. Let's understand the concept. Covered call are natural strategy, meaning the investor only expect minor increase or decrease in the underlying price for life of written call option. So during call option, whatever the stock you have bought, it will not move. Call option may be 1 month or 2 months or 3 months. This strategy is often employed when investor has short-term neutral view on the asset and for the reason hold long asset and similarly has a short position by option to generate income from the option premium. So your target is option premium. You want to earn premium of the options and your stock is not moving in near term. Simply we can put in other words, if investor intend to hold the underlying stock for a long time but does not expect appreciable price increase in near term, then they can generate income option premium for the amount while they wait to out the bull. A, a covered call serves a short term hedge against long position. So you can do a hedging for long position in short term and allows investor to earn income by premium received for writing the option. However, the investor forfeits stock again if the price move above the stock price. If price of stock gains, then you get option premium as well as stock price. So you have double profit. A covered call strategy is not useful for a very bullish or bearish investor. If you are a highly bearish or highly bullish, then do not use. If investor is very bullish, they are practically better off not writing the call option and just holding the stock. The option caps the profit on a stock, which could reduce the overall profit of trade if the stock price spikes. Similarly, if investor is bearish, they may better off simply selling the stock since the option received for writing call option will do little offset to the loss on the stock if stock plummets. So this you must understand. Please go through each and every line and you have to create a concept. Let me know in case of support required. So maximum profit and loss. So let's see what the maximum profit of covered equivalent strike price of the short call option less the purchase price of underlying stock plus premium received. So this is the maximum. The maximum loss is equivalent to purchase price of underlying stock less premium received. So this is the loss. This strategy is usually adopted by stock owner who is neutral to moderate bullish. Please remember, neutral to moderately bullish investor must use this strategy. When to use? This is implied when call is an investor has a short neutral to moderately bullish above the stock. He takes a short position on the call option to generate income from the option period. Reward. Reward is limited to call stock price minus stock price praise plus premium received. Breakeven. What is breakeven? Stock price praise minus premium received is the breakeven. What is risk? Maximum risk is stock price praise minus call premium upside crap at the stock price plus premium received. So let's go. This is the diagram. You can see x axis stock price is there and then you see the break-even point. I will show you another diagram. This is the payoff diagram. You see if stock has expiry, you see that you x-axis and y-axis. So you see how it is increasing from this point. If stock price is going up and your call is going down, so you will get a benefit. This is a covered stock price and profit in rupees. If stock is going up and stock price, you will get the premium. This is the covered call strategy. So you see underlying price at expiry. This is rupees and break-even point has been shown. Profit, stock price. So you just correlate with the strategy deployed. Let's go ahead with the covered call example. A investor owns a company of ABC Limited. They take it long-term prospect as its share price, but feel the shorter term likely to trade relatively flat, perhaps within a couple of rupees of current price of 25. If they sell a call option on ABC, strike price rupees 28, they earn the premium from the option sale, but the duration of option and cap their upside on the stock 28 rupees. Assume they receive the for the waiting 3-month period call option is 5 rupees for 100 share. There are two scenarios. One scenario, ABC trade below the 28 stock price, the option will expire and the investor will keep the premium option. In this case, buy right strategy, they have successfully outperformed the stock. They still own stock but have 81 rupees in their pocket. Let's say ABC goes above 28, the option is exercised and the upside stock is scrapped at 28 rupees. If the price goes 28.75, strike price plus premium, an investor would have better off holding stock, although if they plan to sell 28 rupees, writing the call option give 5 rupees per share. So this is, there are two. If it goes above 28, if it goes below 28, so there in both scenario you will be in profit. So covered call is a good strategy, you can use it. So I covered all. In case of any help and support required, you can contact me. I have shared my mail IDs, WhatsApp number. I am a certified technical fundamental research analyst and NISM certified also. So I am a trader, trainer and investment advisory in equity long term. So please subscribe this video. In case of not subscribed, please press the bell icon. I am going to cover more and more things, so you will have basic concept understanding, then you can go ahead further. Please share these videos to friends so they will also able to learn and understand the option. Option is just like a water. If you put water in your hand and you want to hold it, it is not possible. So please go one by one videos, you will able to understand. In case of any queries, please you can call me from 5 p.m. to 7 p.m. daily in between this, because I also do trading, so for me it is difficult to pick the phone from morning to 5 p.m. So this is what from my end. Please have a paper trade to option. Please understand technical analysis. I already told. Then you try to build up your concept. Then you have a paper trade. Please have a training from NSE certified person and just ask their certificate number, because in the stock market there are so many people who might get profit because of they are doing trading 8 to 10 years, 20 years, but they don't know the concept. So for building up your concept, you must have proper training from NSE certified people or NSE Academy. So this is from my end. Thank you friend. Good night.